Hey traders, and welcome to another episode of Smart Risk. Are you tired of getting stopped out of your trades? If you answered yes, then you're not alone. But don't worry, in this video, we will explain the most effective entry confirmation methods and tools that will pave your way to becoming a profitable trader. You'll discover how to leverage these techniques to your advantage, gain a solid understanding of confirming your trades like a pro, and boost your chances of success in the market. We'll explain the crucial and main types of entry confirmations, from basic to advanced, that will increase your trade's win rate and give you confidence when executing a trade in the market. So, traders, if that's something you're interested in, please give this video a thumbs up to show your support and subscribe to our channel if you are new. See you after intro. Welcome back, traders. So, let's get started. In executing winning trades, confirmations play a crucial role. We are always looking for additional confirmations in our trades to achieve higher quality setups, as they help us filter out risky entries by adding extra layers of validation to our trading strategies. In this episode, we will break down the patterns and tools that can be used as extra confirmations to reach high-quality trades, adding more depth and meaning to our strategies and helping us to filter out risky entries. Now, let's see the main types of extra confirmations that can be used to achieve high-quality trades and identify points of interest with a high probability of success. The first confirmation method is the VSR. The second method involves using a volume indicator on the order block. The third method uses the discount and premium tool in an advanced way to filter out risky trades. The fourth main confirmation method is using the fixed range volume indicator to identify supply and demand. The fifth method covers the second mitigation area after forming a market structure shift or change of character pattern. Now, let's delve into the details of each method and explore how they can be combined with smart money concepts to provide additional confirmation in trades. Starting with the VSR pattern. VSR stands for V-shaped recovery. The basic idea behind the V-shaped pattern is that when the price approaches a demand zone, it may quickly fall and then rise back to its previous level, forming a V-shaped pattern. It's worth noting that the V-shaped pattern can also occur when the price rises quickly and then falls back to its previous level in a supply zone, creating an upside-down V-shaped pattern. This pattern is believed to indicate that a large volume of institutional orders and money is actively participating in the market, pushing prices inside and outside of supply or demand zones. The reason we want to see the V-shaped pattern is that it indicates active participation of institutional money in the market, which can lead to significant buying or selling momentum. For traders, this means we should aim to enter or exit trades in the same direction as the institutional money during a subsequent test of the demand or supply zone. It's important to note that not every V-shaped price movement should be considered a V-shaped pattern and a sign of institutional participation. We should only pay attention to V-shaped patterns that are formed near or within supply and demand zones. Let's look at some examples. Here we have Euro-Dollar 15-minute time frame on the chart. As you can see, the price suddenly dropped, forming a swing low. After mitigating a higher time frame demand zone, it quickly rose back up to its previous level, creating a V-shaped pattern. This movement left behind a new demand zone and a fair value gap, presenting a great opportunity to go long at the demand area or the fair value gap. The V-shaped pattern indicates that the price found support at the bottom and was pushed back up by strong buying pressure, suggesting that institutional money has entered the market. Recognizing a V-shaped reversal pattern as an additional confirmation, along with signs of a market structure shift like a change of character, increases the probability of a successful trade. For example, in this trading scenario, you might see this V-shaped pattern as a bullish signal, indicating the entry of institutional money. Consequently, you could consider entering a long position to take advantage of the potential upcoming uptrend. Now, let's move on to discussing the second confirmation method, using volume indicators in demand and supply areas. The volume indicator is typically represented by vertical green and red bars on the x-axis, showing the volume of orders executed within specific time periods. This indicator measures trade volume rather than momentum. Each bar represents the total volume of buy or sell orders filled within the corresponding candle period. Green bars indicate positive volume, suggesting bullish momentum in price, while red bars indicate negative volume, suggesting bearish momentum in price. The color of the bar depends on whether the candle closed above or below its opening price. An increase in volume during an uptrend signals a continuation of the trend, indicating strong buyer interest. Conversely, a decrease in volume during an uptrend suggests waning buyer interest and could signal a temporary pause, a pullback, or a potential shift in market structure. Similarly, an increase in volume during a downtrend indicates a continuation of bearish momentum. On the other hand, decreasing volume in a downtrend suggests weakening seller interest, potentially signaling a pullback or a shift in market structure towards bullish movements. Now that we've covered the basics of the volume indicator, let's see how we can combine it with order blocks as an extra confirmation for entry. As you know, order blocks are known as decisional areas that form before institutional orders are executed in the market, and the price is expected to react to these areas when approaching them. Identifying an unusual increase in volume, especially where the price is forming a supply or demand area, confirms the theory of institutional money and order blocks. This can be used as an extra confluence factor before entering a position. A sudden increase in volume within these areas indicates their importance, suggesting that if the price returns to them, there is a high probability it will respect these zones. This confluence factor is not entirely necessary because it doesn't happen very often. However, keep this confirmation in mind as it provides a strong signal for identifying high-probability demand and supply zones. Now let's dive into the next confirmation method, premium and discount areas. If you want to execute trades with the highest possible probability of success, using premium and discount areas to filter out risky entries can significantly increase your win rate. Generally, for a high-probability trade, it's better to buy in the discount area and sell in the premium area. Additionally, premium and discount zones can be used to identify higher quality supply and demand zones for positioning entries. For example, in a bullish market, focusing on trading demand zones located within the discount zone can enhance our trading strategy and minimize potential losses. Mostly for identifying premium and discount areas, we are using the Fibonacci retracement tool. Now let's see how we can draw premium and discount areas on the price chart using Fibonacci. For a downtrend, select the Fibonacci retracement tool and drag it from the most recent high to the most recent low. This will create the Fibonacci levels on your chart. The area below the 0.5 Fibonacci level is referred to as the discount zone, while the area above the equilibrium line is known as the premium zone. It is important to note that these zones are only reliable if there is an impulsive movement that breaks the recent price structure. To enhance our analysis of premium and discount zones, we can divide this zone into 3 equal parts and assign different colors to these segments. To enhance the likelihood of successful trades, aim to buy in the discount zone and sell in the premium zone. The red section on the chart signifies a deep premium zone, indicating a good opportunity to sell. Conversely, the blue section represents a deep discount zone, suggesting a favorable time to buy. It is not advisable to buy in the red zone or sell in the blue zone, as price reversals are likely, which can trigger stop losses due to low liquidity during significant moves. Trading in the gray area is relatively safer, but the closer you get to the premium or discount zones, the riskier it becomes to trade against the zone colors. For example, in a bullish scenario, the price creates a bullish break of structure by breaking and closing above the latest swing high. By applying the Fibonacci tool from the most recent swing low to the most recent swing high, we can identify the deep discount and premium zones, as well as the gray neutral zone on the price chart. Since we are seeking to initiate long positions in this example to add extra confirmation to our trading setup, we should ignore fair value gaps or demand zones located within the deep premium zone and the gray zone. For placing entries, our focus should be exclusively on fair value gaps or demand areas situated in the deep discount zone. The fixed range volume indicator, also known as the fixed range volume profile, is a technical analysis tool used in trading to visualize the volume traded at different price levels over a specified period. It plots a histogram on the vertical axis showing the volume traded at each price level over the selected range. This helps traders identify price levels with high trading activity, often indicating supply and demand areas on the market. The indicator calculates the total volume traded at each price level within the selected range. It aggregates all buy and sell transactions. Now, let's see how we can take advantage of the fixed range volume indicator as an additional confirmation method. You can add this indicator to your chart by clicking on the Indicator tab and searching for Fixed Range Volume Profile. And then click on it. After adding the Fixed Range Volume indicator to your chart, you need to set a range for analysis. To do this, select the start and end points on the price chart for which you want to analyze the volume. For example, here I will set the highest and lowest points of this bearish impulse movement that caused a bearish change of character by breaking and closing below the most recent swing low as the range for the volume indicator. Now, as you can see, the volume indicator has been added to our price chart, displaying horizontal bars within the selected range. Now the question arises, how can we use this indicator to our advantage? Here we can see that the price formed a change of character, indicating that the market is about to shift its direction from an uptrend to a downtrend. As a smart money concepts or inner circle trader, we are looking for an opportunity to go short from the supply zone that has been recently created by the bearish change of character. Since the fixed range volume indicator shows the volume traded within a determined range, we can easily identify the levels within our range where the highest volume was traded recently. These high volume levels can be considered strong supply or demand zones that the price will likely react to if it returns to them again. However, most of the traded volume is concentrated within this range, representing a supply area. Additionally, this supply area coincides with the order block generated by the change of character. By using the fixed range volume indicator, you could have executed a sell position from the extreme order block with extra confirmation based on the traded volume. This indicator shows the levels where the most volume is traded and also identifies order blocks. However, please consider that it doesn't always work 100% effectively, and you should not place entries solely relying on it. Despite this, it is the most effective and accurate among the various volume indicators available. It's best to use it as an extra confirmation in your analysis to execute trades with higher probability. Now let's move on to the fifth confirmation method, the second mitigation area after forming a market structure shift or change of character pattern. To better understand this confirmation method, let's consider a trading example. First of all, we can see that the market is in a downtrend with supply zones in control. After a temporary pause, the price changes its direction to the upside, makes a pullback, and eventually mitigates the higher time frame supply zone. The price reacts to this zone, reverses its direction, and forms a change of character in the current time frame. Let's imagine that we didn't enter the market for any reason and are now looking for an opportunity to take short positions. For this, we need to wait for the price to break and close below a primary structure in the lower time frame. As soon as the price forms a change of character, we expect it to retrace and pull back to mitigate the order block that is formed within the higher time frame supply area. This will be the second mitigation of the higher time frame supply zone, as the change of character wave order block is formed within this supply area. So, in this confirmation method, we should wait for the first mitigation and reaction of the higher time frame supply or demand area. After observing this initial reaction, we then look for a second mitigation to enter the market. This approach provides additional confirmation that the supply or demand zone is likely to hold, increasing the probability of a successful trade. Generally, second mitigation order blocks provide a high probability of success when used as entry points for executing trades, as they tend to hold up quite nicely. However, it's important to note that this confirmation method is valid and can be used to execute trades only under one condition. The price must form a lower time frame order block that aligns with the higher time frame direction within the higher time frame's order block or point of interest. Otherwise, it is not advisable to execute trades based on the second mitigation of an order block. That's it, traders. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.